Greetings, everyone, and welcome. I'm not sure where you're sitting in the world today, but good morning, good afternoon, good evening, as the case may be. My name is Jeff Stewart Hosey. I'm the Managing Director of PairTrade Finder, and today we're going to talk about why you want to pair trade stocks. So without further ado, let's get into it. So let's cut to the quick and get to the heart of the matter. Are you interested in a trading system that can be easily learned, has a multi-decade track record of success, can help you deliver consistent trading income month in, month out, works in most market conditions, and can protect you from a large drawdown? I would also add in that if you use our platform and follow the automatic signals generated by it, you can do the strategy in under 1 hour a day once you've learned your craft. Okay, so what is a pair trade anyway? Pair trading involves simultaneously entering long, i.e. buying, and entering short, i.e. short selling, two paired securities, very similar securities like IBM and VMware or Coke and Pepsi is one that's used all the time as an example. However, you need to analyze to pick the right ones. It's widely used by investment professionals due to its proven success. Let's look at that a bit more closely. Investment managers love its controlled risk, low correlation to market averages, and the ability to generate significant and consistent returns. Here you have a graph from Barclay Hedge showing for the last 10 and a bit years what the assets under management of all equity long-short strategies are in the world, and that's gone up to 225 billion at its zenith and is still around 170 billion. Now, not all of these are the type of quasi-statistical arbitrage of US equities that we're talking about in our strategy here, but that's definitely subsumed into this category. So the strategy was originally credited to Alfred Winslow Jones. He's an Australian immigrant to the USA. He was educated at Harvard and Columbia and was the founder of the first hedge fund, A.W. Jones & Co. That term was coined by Carol Loomis of Forbes magazine when she was doing an expose on Jones because of his extraordinary success. Okay, so what was Jones's approach? Jones married two speculative tools to create what he considered a conservative investment scheme. Interesting, he considered it conservative. First off, he used leverage to buy more shares than his capital, and he would short sell to avoid market risk. And both of those things are traditionally thought of as being aggressive, leverage and short selling. However, when they're done in this manner, we can see that they lead to a natural hedge and therefore can be termed in some sense as a conservative investment scheme. So you buy as many stocks as that are sold. Okay, so if you got 10 million, you buy 10 million worth of equities long and you short sell 10 million of equities. So market-wide moves up or down would be a wash. That's if the shares that are sold short and bought long perform in the same manner. The crucial question then would not be the direction of the market, because if it goes up, it should stay neutral, and if it goes down, they should stay neutral, but whether the manager had picked the right stocks to buy and sell, because you want the longs to do better than the shorts. And that's how long-short equity trading was originally crafted by Jones and is still in use today by many different hedge funds. How did he do? Well, for the first 5 years, 1960 to 65, Jones's fund returned more than 325%, despite a 20% management incentive fee. On a 10-year basis, Jones's hedge fund delivered 670% net return to investors. Importantly, that's after fees. Without the fees, it was probably more like 8 or 9 times investors' capital on a 10-year basis. Here's a chart we dug up from way back when, and you can see sort of 59 to 65 how his fund performed. So from that extraordinary start by Alfred Jones and his hedge fund, many people have come to terms with this strategy and started their own hedge funds and developed it very successfully. Tartaglia and Shaw at Morgan Stanley during the 80s were making upwards of 50 million a year for Morgan Stanley. David Shaw spun out of that and created D.E. Shaw. But there's something that a lot of people don't know, and that's that the largest hedge fund in the world uses pair trading. Jim Simons of Renaissance Technologies testified to the U.S. Congress in November 2008 that his fund PairTrade stocks. You can listen to this testimony. It's on our YouTube channel, PairTrade Finder YouTube, and just type in what is the best trading strategy. And he talks about their in-house fund called the Medallion Fund. It used to be opened outside capital, now it's just for themselves. The Medallion Fund is famed for the best record in investing history, returning more than 66% annualized before fees. That's before fees, and then 39% per year after fees. These fees are upward of 30 to 40% success fees per year. And it did this 66% annualized over a 30-year span from 88 to 2018. Let's just understand that compounding. That rate of return, if you put a buck with the Medallion Fund in 1988, in 2018, that $1 was worth over $4 million. Do we have your attention yet? This is serious stuff. Okay, well, that's great for Jim Simons and Renaissance with their billions of dollars and rooms full of PhDs that can find every single pair trading opportunity that's out there and profit from it. How about the online trader? And here's a quote that I want to read to you from Chris Stoner at Investopedia. I think it says something that all of us deep down kind of know, which is it's rarely in the best interest of investment bankers and mutual fund managers or hedge fund managers to share profitable trading strategies with the public. So the pairs trade remained a secret of the pros and a few deft individuals until the advent of the internet. So what does that mean, the advent of the internet? Well, recent studies, which we cover below, show that this trading style continues to deliver superior returns with lower risk, especially in volatile markets. However, now it's not just the institutions. Let's talk about the internet, and let's talk about the advancements in computer power and trading software platforms like the one we sell, PairTrade Finder Pro. Cheap real-time market data, low online brokerage commissions, and now we're talking zero online brokerage commissions, and cheap leverage available for the retail trader. IB, I know interest rates have spiked recently. It's a higher cost, but even with the spike, IB is offering anyone with an IBKR Pro account with $0 to $100,000, 3.83% per year leverage cost. So that's not too bad. And through CFDs, like the leverage available for the retail trader through CFDs in Europe has leveled the playing field and elsewhere. You can't get those in the US, and you can look at options trading. But even with portfolio margin, with IB, you can get maybe 4-to-1 leverage, which is more than enough. Listen, the one thing that retail traders have versus the institutions is their small size. We can trade in and out of positions that they just can't because they'll move the market. And we need to learn to use that to profit. Why does it work? Well, contrary to popular belief, a form of logic does run through the world's stock market. Most of the time, stocks are priced efficiently. That is, all information is discounted in a logical, relative manner. However, every now and then, the market does something unexpected and creates an inefficiency or an anomaly. Stocks trade like schools of fish. Look for an outlier. So if this is the way all stocks are moving, and all of a sudden one stock, or fish in this case, starts moving away from this school, there's a very reasonable expectation that he will head back into the school of fish, because that's the way they tend to move. Same thing with stocks. And there's a way of measuring what the probability of a fish going back to the school would be. So stocks, why do we get these inefficiencies or these anomalies? Stocks don't buy and sell themselves. Those orders are entered by people, and people are driven by emotions, and emotions cause irrational decisions. And this emotional decision-making characteristic is multiplied exponentially when it comes to crowds of people. As we can see here on stock exchange floors, when you have big reactions to news, which may or may not have any fundamental bearing on the valuation of equities. For example, it wasn't too long ago, I think it was about a year ago, that the averages dropped 10% in the space of about 3 days, and then 3 days later they were back to where they started. So that type of emotional seesaw is what's creating these anomalies. What I'd add is that we have these massive high-frequency traders involved in the market now, and anytime they see a major move in a stock, they begin to introduce waterfalls of high-frequency trading orders, which oftentimes exacerbate the move itself. And so you've got a fundamental dislocation between where one share price may have gone relative to a highly correlated and co-integrated other share that you can pair it with. So if for no good explanation, for no good or explainable reason, such as news affecting fundamentals, two highly correlated and co-integrated stocks, this is very important. For example, let's take an example here, IBM and VMware, they diverge away from each other. There's an inefficiency created and an opportunity to profit. Okay, so now that you've identified the divergence or anomaly, mispricing potentially, in the relative performance of two correlated and co-integrated shares like IBM and VMware, how do we enter a pair trade? Very simply, we buy long the relatively weaker share of the pair, i.e. the long leg, and we sell short the relatively stronger share of the pair, the short leg. If, for example, IBM has performed way above VMware for no identifiable good reason, we would sell short IBM and go long VMware. And what we do is, because these shares are very similar, they're co-integrated, correlated, they tend to have very similar betas. Therefore, to keep your trading strategy easy and straightforward to manage, we do dollar neutral pair trading. And so if we're going to go long 10,000 shares of VMware, then we go, if we're going to go long $10,000 worth of VMware, then we sell short $10,000 worth of IBM. So we'll see that in a bit more detail on the next slide. Take a look. So this is the last year. This is IBM versus VMware, the relative performance graph. If you start 1 year ago, you can see they're both at 0. And this is what their returns have been doing on a daily basis over the last year. Now, I would highlight that IBM and VMware, which are actually in our last Fast 50 group, are correlated and they are co-integrated. So what you see when we say, it's important to understand correlation and co-integration. Correlation would mean that when one goes up, the other tends to go up. When one goes down, the other tends to go down. It doesn't necessarily mean that their relative performance will match. It just means that they move in a similar direction. So when we talked about a fish swimming outside of the school, what are its chances that it will rejoin the school? Well, if you consider these two moving together as being a school, if one swims way out, what are the chances it's going to go back to where it was, i.e. performing the same as our pair? That we can measure with something called co-integration, and we'll have more on that later in our series. But for now, let's just say that if a pair is co-integrated, it means that when their relative performance diverges, like here, it's likely that it will reconverge, like here. Okay? So when it gets to a certain level, which our software will measure for you and call signals for you to trade, you would, for example, in this pair, so VM is blue and IBM is green, you would sell short VMware at this point, let's say $10,000 worth, and you would buy long $10,000 worth of IBM. And you would exit that trade when the relative performance converges. And on this long position on IBM, you probably would have broken even, maybe a slight gain, but on your short of VM, you would have made a lot of money. And so that would have been a profitable pair trade. Here's another opportunity, very divergent relative performance. When it gets to that kind of extreme, you would short IBM in this case, go long VMW, and close when that relative performance converges. So the main benefit of pair trading that we really want to highlight so that you understand is that your exposure to market and sector risk is significantly reduced, i.e. it's hedged by holding both long and short positions in equal dollar amounts in a single or highly correlated set of market sectors. Okay, this is an old pair, very small leg size, but so it was ticker MAS, ticker BECN. There's a trade called to go long MAS and short BECN. So that trade was entered at $2,500 a leg size, 63 shares of MAS, 44 of BECN short. And what do you see? Well, over time, the market has moved up. So on MAS, you've made money, and on BECN, you've lost money because you're short. However, look at the P&L. You've made more money on MAS than you've lost on BECN, and that differential, here's $31 on an initial margin of about 1,000. It's only 3%. Usually our trades come good at about 10 to 20%. But that difference in the relative performance going your way is what you look to capture as a profit in pair trading. But what you can see from this is even though the market has risen by over 5%, for these securities. So MAS is up 5.41. BECN is up also 5%, but that's a negative because you short it. What you see is that the actual P&L is not moving very much at all. Okay, so there's a 276 profit here, and if you'd just been short, you would have had a $245 loss. But the net result is only about 31 bucks, and it's that net result going in our favor, which is what we're looking for. So you're protected in a large extent from overall market moves and protected to a large extent in overall sector moves, because these stocks are always in the same, we trade stocks that are always in the same sector and almost always in the same industry subsector or very closely related industry subsector. So let's try and summarize the most important element as to why this strategy has had such longevity and tends to work. It works because the relationship between two correlated and or co-integrated stocks is much more predictable and reliable than the outright prediction of the direction of a particular stock. It's very hard to know when on any given day where the price of a security is going to be in 20, 30, 50, 100 days. It's just very difficult to predict stocks. So we just jump over that and say we're not going to predict stocks. What we're going to predict is that, for example, two highly correlated securities, SPY, S&P 500 ETF, DIA, Dow Jones Industrials ETF. You can see the correlation. When one moves up, the other moves up. When one moves down, the other moves down, but not perfectly. And so here's a quick spread analysis. When this distance gets very far, as measured by this blue line, it's going through standard deviation lines like Bollinger Bands around the moving average, okay, of the ratio between SPY and DIA price ratio. And so when it gets really extended, okay, we can just look at this visually. Like here, they're very extended. You would go long here and short here, and when they reconverge, you're going to make money because this difference is converged to zero. So you don't need to know whether the stock market's going to go up or whether it's going to go down. You don't care. You don't even care if it goes sideways. What you do care about is whether, because these two have stretched apart for some reason, that they are going to reconverge. And in this case, they did. And let's see, here's a big divergence and a divergence here. And look, reconverges here. So yes, they reconverge. And if you look historically, they always reconverge. So that's what you're looking at to do with pair trading. You don't need to guess the direction of the market or the direction of a stock. You're just looking at the direction of the relationship between the two. So to recap, why you want to pair trade stocks. So if you're worried about in the past or at the present moment, bad trading decisions, rising interest rates, inflation, recession, unemployment, stagflation, war, market volatility, investment earnings, a market crash, don't be worried about any of this. Instead, use stock pair trading to generate consistent monthly trading income, hedge against market risk, sector risk, and a big account drawdown. We just showed you that. Profit from market volatility, and we're going to have more on this later in this series. And in general, just stop worrying about Mr. Market. You're not trading the market. You're trading the convergence of the relative performance of co-integrated and correlated stocks. Okay. So what do we know about this? There's been extensive research done to show that it's been profitable over multi-decades. I think one of the ones we like to highlight is this: pair trading and selection methods is co-integration superior. It's by Huck and Afewubu. And one of their most important conclusions: robust pair trading strategies are the following. Co-integration as a pair selection method. Returns are especially high with monthly excess returns, including transaction costs, greater than 1.38% per month versus the S&P 500, and going up to about 5% per month over a period of more than 10 years, depending on how you select the pairs and how you trade them. Okay, 5% a month excess return versus the equity averages, and this is unlevered. That's a very astounding finding. Many other studies have backed this up. Okay, so we're going to cut it there, and just to highlight, so what's coming next, look for the next video in our series, which will be sent to you on email, and we're looking at pair trading profits in volatile markets like we've had this year, and how have our recent live signals performed. We're going to go into that in detail. Happy trading, everyone.